Hi, and welcome to The Purposeful Banker, leading commercial banking podcast brought to you by Q2, where we discuss the big topics on the minds of today's best bankers. I'm your host, Jim Young. Welcome to the show. It's that time of year when we hold our annual State of Commercial Banking webinar. To give you a preview of what's in store, we have Gita Tollison, manager of Q2 Strategic Advisory Services and one of our resident experts on applying the proprietary data from Q2 Precision Lender to identify market trends. Welcome back, Gita.
Thanks, Jim. Good to be with you. It's been a couple of years since you and I have done one of these together.
It has. I'm excited to talk about this, and as usual, we'll have to rein myself in from revealing too much of what you're going to be talking about in the webinar, which, by the way, will be on February 8th, and we'll have a link to where you can sign up for the webinar in our show notes. But I'm going to want to talk to you about everything that's in the report, and you'll have to rein me in and make sure that we give people a little bit of a preview without giving away the whole story.
Sounds good. Will do.
All right. So first off, let's back up. For those who are not familiar with the State of Commercial Banking, can you explain just a little bit more about this report? How many years has it been now that we've been doing it, and sort of what the thinking was behind it?
Yeah, so this will actually be our sixth State of Commercial Banking report and webinar. The first one was in 2019, January of 2019. So this will be the sixth one that we're doing. And it's really meant to be a retrospective on what's transpired in commercial banking over the past year, where we're sitting today, how things are looking on a going forward basis as well. And clearly this year has been quite different from prior years. So the themes have been different, but it's still sort of the same overall goal to take that 10,000-foot view on the commercial banking market and show folks what our data is saying about the market.
And that segues right into my next question, which is about the data. Can you kind of tell our listeners about where you're pulling from, what sources, and then also maybe a little bit about, for those who have been regular State of Commercial Banking attendees in the past, what might be a little bit different in terms of data for this year?
Yeah, absolutely. So there are several sources of data that we use. There's some public information, Fed, FDIC data that we like to look at to provide some context around the market. I think as one example, this year we're looking at volume, pulling some Fed data as well as our own proprietary information, but looking at it with a very different lens. So in the past, we used to report, almost interchangeably use the terms loan volume and loan demand, because typically when you saw overall volume increasing, that was a signal that loan demand was getting stronger. We're no longer calling it loan demand anymore, because now we're starting to see that banks are pulling back. So we're looking at the same metrics around volume, but now it's perhaps viewed with a different lens as more of an indication of supply contractions. But then on the proprietary side, we have multiple sources of data that we're tapping into. So we have over 150 commercial banks and credit unions that are running the Precision Lender platform. And from those institutions, we really have fantastic visibility into what's happening in the market. There are two distinct sources of data that we're using for this report. One is a database of actual commercial relationships. So our clients are feeding to us the full commercial relationship. That's credit, it's commercial deposits, and then it's ancillary fee-based business, so treasury services, corporate card, and so on. And so we're getting that data typically on a weekly basis from the system of record. It's a good reflection of what's actually happening out there. But then the second data source that we're using is a data source based on what folks are actually putting into the Precision Lender platform. So as RMs are working through deals, as they're exploring pricing and structure and relationship, we have visibility into what they're contemplating. So those deals may not have closed yet. They may not close for another couple of months, but it's a fantastic forward-looking indicator of what they're thinking. Is pricing going up? Is, what's happening in terms of just activity and volume? But then the related piece to that is for clients that are using the Precision Lender platform, we also have visibility into what executive management is planning and thinking, because we can see what management is putting in terms of assumptions to drive RM behavior. So things like, cost of funds and liquidity premiums and FTP credit on deposits. So we can see a lot of that information. And really, for the first time in this report, we're really tapping into that management level information to see where folks are headed from a strategic point of view.
Yeah, just speaking from someone working with NFA Law during the year on some of these market updates, some really interesting cases in which sometimes what banks were doing and their tactics didn't totally match up with some of the more public funding curves and that sort of thing out there. But again,
exactly,
got to check myself. I'm not revealing too much from the report here.
Yeah.
Let's take a step back again here on the timeline here. This time, since last year, a lot has really happened. The rate hikes and that sort of thing seem to have slowed down, but even so, hearing a lot of bankers say, 2024 could be a tough year, or maybe euphemistically a challenging year. If you had to write sort of one headline about this year's report, what would it be?
So I'd say the 2023 headline would probably be something like 2023, expect the unexpected. And the reason I would say that is, if you think back to what we were talking about this time last year, the market was not looking like what it ultimately panned out to be. So the beginning of last year, we were in a spot where we were starting to lose some deposits. We were starting to see those outflows. Banks were all over that. They were starting to raise rates. And we thought, okay, this is going to slow down. This is going to stop. Things will return to normal. And at the same time, there were a lot of signals that the economy was poised to slow down. And so the feeling was that even these incessant rate hikes would very soon come to an end. And if anything, the Fed would start to reverse course. So everything was going to sort of return back to normal. And obviously, we all know that didn't quite happen. We had a bit of a stronger economy than we had anticipated. That kept the rate hikes going until the summer. And the deposit outflows didn't slow down. If anything, they accelerated and ultimately culminated in a couple of pretty sizable bank failures. And so, really, when you think about sort of the unexpected, I think maybe a better way of saying it, it's not so much about expecting the unexpected. It's more about being prepared for the unexpected, right? So if you look at what happened with those couple of banks that really struggled during the spring, they had just an abundance of uninsured deposits, and they had sort of taken a lot of their excess deposits from that period of excess liquidity, and they parked those funds into held-to-maturity securities, so highly illiquid securities, right? So they weren't prepared for the unexpected. When the unexpected happened and deposits started to flow out of the system, they really couldn't liquidate those securities fast enough. And so, who knows what 2024 will bring? Maybe it'll be better. And some folks are predicting some relief from the Fed. Some are saying it's going to be, higher for longer. But whatever happens, we just need to be prepared and be able to pivot quickly as needed.
Throw in there too a presidential election towards the end of the year, which I'm sure will probably have more unexpected for that one as well. Before I dive into the data, I just see one more sort of thing. Again, you've got a little bit of an interesting, having done these for 6 years and seeing sort of like sometimes you go into a year and you take a look back at what happened and you look forward and say, this is what could be out there for 2020, the next year. I'm sort of curious though, from the lens of, it's been 40 years now, hard to believe, since COVID hit the U.S. We had the shelter in place and PPP and all that sort of thing. What are some of the things when you look back in those 4 years with 2020 hindsight, and look back at how the commercial banking market responded to everything that's happened during that time period, that kind of stick out to you that are of interest?
Yeah, I think the repercussions from the pandemic are still being felt in today's market. I'd say so separate from PPP, all the federal stimulus, I'd say the one thing that stands out to me when I think back to where we were and what happened is just, and this isn't specific to commercial banks as much as to businesses overall, is just the resilience that U.S. businesses showed in terms of reinventing themselves, coming up with new operating models on the fly. I remember that when we first heard the announcement that we couldn't gather in a room with more than 10 people. You remember that? And, so you start to think, well, okay, I can't go to work tomorrow. I can't go to a restaurant. I can't get on a plane. I can't go shopping. I can't do anything. And, at that point, it really started to feel like we were headed for another Great Depression. So not even a recession, but a depression. And it was just so hard to even fathom how we'd come out of it. And separate from what the government did in terms of stimulus, companies started to develop new operating models. And so we had, all of a sudden, you could still conduct business, just do it via Zoom or Teams. You could still, instead of traveling to see customers, you did it that way. Instead of going to a restaurant, you had DoorDash and Uber Eats. Instead of shopping in a mall, you had online shopping, which existed before, but was never really used to this degree. So, that was really just remarkable how, probably all of the stimulus that was injected into the system wasn't even really needed because companies were able to sort of figure out a way of kind of staying afloat and turning a profit. But I think the other piece of it is related specifically to banking. During that period where there was so much stimulus and such cheap financing, so think about PPP at just 1% interest, forgivable if you used it for the right reasons, but even if you used it for the wrong reasons or just wanted to sort of, keep those funds, 1% is pennies compared to what you'd pay in the bank loan market. And so the impact of that was just so much excess liquidity pumped into the system. There was so much capital that drove this incredible rise in deposit balances. Banks were sitting on so much capital, they didn't know what to do with it. And so that was really sort of an anomaly compared to, the typical cycles that we're used to. And then as quickly as that all rose in 20 and 21, it sort of fell off a cliff in 22, 23. And so it's still the same impact, but it was essentially what was happening was that, rates were continuing to rise as the Fed was trying to combat inflation. Deposits started to flow out. And, that's all really sort of a longer term impact of what happened during the pandemic. So we're still kind of feeling the impact of it even now, 4 years later. So it's pretty remarkable. And hopefully things will start to normalize in the near future.
Yeah, I was telling someone, we were just kind of thinking back, and I was like, it's almost hard for me to believe we were at that point of like banks saying, what am I supposed to do with all this liquidity? How am I going to get this out the door? And now
exactly
180 degrees different now.
Yeah.
So taking a look a little bit, when you sit down to the end of the year to review this data for a report, you've got an idea of, what's happened during the year. But I'm sort of curious, did you find anything in the data that surprised you? And then I guess along that, was it a surprise of, wow, that's the opposite of what I thought? Or was it more of well, I expected this, I just didn't expect this to this degree?
Yeah, I'd say maybe the latter. I'd say specifically what I found most surprising, you mentioned Anna Phelan. She did some fantastic analysis around deposits. So obviously this year, the focus for a lot of banks has been around, how do we grow deposits or at least stem the outflow of deposits, hold on to what we have, right? So Anna Fay did some fantastic analysis where essentially she looked at the variance across financial institutions in terms of their success in growing or maintaining deposits. I was really stunned, first of all, to see just how much variance there is. I wasn't expecting it to be that divergent across institutions, to the point that there were some banks that were actually tremendously successful at growing commercial deposits, even against this backdrop of deposits kind of leaving the system. And then you have other banks that maybe followed more the market trend of sort of, seeing the slow bleeding or maybe quick bleeding in some cases. And the other piece of that, NFA did some really interesting analysis to try to understand the drivers of those differences. And that was really striking. in effect, everyone sort of thinks, okay, it's all about how much you're paying for these deposits, right? So that you'd sort of think, okay, the banks that are more successful, they're probably paying a little bit more to hold on to these deposits. And that's true to some degree. But even more than the rates that they're paying to customers, what she found was that the internal trigger, so the internal FTP credit that bank management is sort of telling their RMs, here's how much credit we're going to give you in terms of relationship profitability for these deposits. That, if anything, turns out to be an even stronger driver of success, because in effect, it's the messaging you're giving your RMs, and there are cases where banks have very, very high FTP credit on interest-bearing deposit accounts. Meantime, the actual rates they're paying might be very skinny, and yet those banks are just seeing tremendous success. So that was a real eye-opener to see just how much of a gap there was between FTP credit and cost of funds, as well as how impactful that is in actually expanding deposits in the current environment.
That's fascinating. So if I can put it as I always have to in non-banker terms, it sounds like sort of what you're saying is one of the biggest determinations was how well you incentivize your RM to essentially sell the deposit or to go out there and try to add deposits more so than price, I guess, for lack of a better.
Yeah, and it may not be, actual RM incentives. It may not be directly tied to compensation as much as right. You're encouraging them. You're sort of giving them the signals that, if you want to achieve profitability, maybe, reach our bank's ROE targets, here's one way to get there. And it's actually easier to get there with deposits than with loans, and, including if it's interest bearing. So there was a time where banks were really encouraging their RMs to go after core deposits or non-interest bearing deposits. Those are free deposits. They're presumably worth more to the bank, cheaper source of funds. And now it's actually the case where even interest bearing deposits have just as high FTP credit as the core deposits. So it's a signal to RMs go after these accounts.
One thing I meant to mention when you were talking about the sort of going back to a little bit of the COVID conversation, I remember sitting in an empty office building during that period and thinking, this can't bode well for the CRE sector, basically.
Right.
And I'm wondering but at the same time, I'm wondering are we going to see, or do we see in 2023 sort of eventually the ripple effect of that actually, I guess, hitting the market?
Yeah, we are starting to see that. We did a survey recently where we actually asked bank executives where they're starting to see signs of credit stress. And within the CRE sector, we broke that out between office buildings and then everything else. And it was actually 100% of the executives said the office sector is starting to see some stress, starting to see downgrades. But a pretty high percentage also said other areas within the commercial real estate market. And so, there's a ripple effect, right? So if you stop having people commuting to work, then all the commuter foot traffic is going to suffer, and then the related businesses, so retail establishments and other businesses will suffer as well. And so the expectation is that there will be an impact there. And we have looked at our own data to look at downgrades and did see an uptick in downgrades on commercial real estate deals, a little bit on the C&I side as well, but definitely more so on the commercial real estate side. So it's coming. It's not severe just yet, but it's really the one area we are seeing a bit of stress.
And then looking forward toward 2024, I know you haven't even had a chance to get the webinar yet, but I'm already starting to think through 2024. What are some of the things you're going to be sort of looking for, watching for, in market updates and that sort of thing that you'll be tracking?
Yeah, so I think the big unknown right now, and I'm really interested to see where this is going to land, is all of the regulatory changes that are taking place. And so there was just another extension on, when the U.S. proposed regulations, will be need to get reviewed. And they're looking for feedback. Originally, I think it may have been November, and now it's January. It's probably going to get pushed out even further. But it'll be interesting to see the impact that has on the banking market. So is it going to be a case where banks pull back even further on credit because now they've got to hold another 20-25% capital? Is it the case that they'll start to pass along those higher costs to customers and sort of price folks out of the market? Is it the case that they're going to sort of take those regulations as is and actually implement that in terms of their pricing process, which could lead to some interesting outcomes given sort of the disconnect that we're seeing between where those regulations are, at least today, versus where actual market pricing is. And so it'll be really interesting to see where that shakes out. And I'd say the other thing, I know we haven't really spoken about the other piece of this paper that's being written by Debbie Smart. I think you're probably going to have another session with Debbie later. But the other piece that she talks about that'll be interesting to see is AI and how AI will impact the banking market. It's impacting all industries, and so it'll be interesting to see where we land on that in the coming year.
Yeah, glad you mentioned Debbie, because I did want to mention that she will be presenting. We basically on this one talked really about the credit, deposit, et cetera, but she's going to be talking about those things, AI and also payments, those types of areas of commercial banking. Yep. And we've mentioned Anna Phelan's name a couple of times on here. People have read her market updates, but she'll be part of the webinar as well. Is that right? That's right. Absolutely. That is truly a dream team of talent. So definitely encourage everyone to register for that webinar on February 8th. We will have the link to it in our show notes. Also, you mentioned about regulatory Basel III. I should note that Steve Collum came on in if you missed it, a few shows previous, he came on and walked us through a lot of the intricacies of Basel III and its potential impact. And so definitely encourage you to give that a listen, even if you are not one of the big banks that's dealing with that. The ripple effects of that are going to affect the entire industry. So, Geeta, thanks so much for coming on. Again, really looking forward to the webinar and to your report. And hope to talk to you soon.
Sounds great. Thanks, Jim.
All right, that'll do it for this week's episode of The Purposeful Banker. If you want to catch more episodes, please subscribe to the show wherever you listen to podcasts, including Apple Podcasts, Spotify, Stitcher, iHeartRadio. If you prefer a video, you can find us on YouTube as well. As always, please let us know what you think in the comments and head over to q2.com to learn more about the company behind the content. Until next time, this is Jim Young, and you've been listening to Purposeful Banker.